rocket speed growth, rapid reforms. So why are foreign investors fleeing India? A miscalculation or something else? The world's fastest growing major economy, noise everywhere about infrastructure, highways, railways, airports, digital payments, startups, and from every platform the claim that India is the superstar of the coming decade. But behind the shining picture, there's a strange silence. In stock market numbers, in foreign investment data, one question keeps coming up again and again. If everything is so right, why are foreign investors pulling money out of India? Are they seeing something that we are not? Or is this going to become the biggest miscalculation in history? Let me tell you, India's story right now feels like a rocket launch. When the world's major economies are struggling with slowdown, recession, and political uncertainty, India is moving ahead with 7 to 8% growth. From manufacturing to services, from domestic consumption to government investment, activity is visible everywhere. The government has rolled out a package of reforms that had been demanded for decades: GST, IBC, digital infrastructure, changes in labor laws, and a strong focus on capital expenditure. For the average investor, it feels like conditions could hardly be better. That is why, when the numbers for foreign portfolio investment, or FPI, come out, they are surprising. Over the past year, foreign investors have been consistently selling Indian stocks. Sometimes sudden large sell-offs, sometimes slow and steady withdrawals. This has also reflected in market movements. The indices have stayed up, but not with the kind of momentum one would expect from India's growth story. And that's where the question arises, are foreign investors losing faith in India's story? Many global experts have expressed surprise at this trend. They argue that if an investor is exiting the world's fastest growing major economy, then either they are thinking very short term or they are missing something big. Because typically, capital flows to where growth is. And by that measure, India is still right at the top. So why are foreign investors selling? The first and most important reason is profit booking. Over the past few years, Indian markets have delivered excellent returns. For many foreign funds, India has been a success story. In such a situation, when global uncertainty rises, interest rates in the US, recession in Europe, geopolitical tensions, fund managers first pull money out from places where they have already made good profits. India was high on that list. This selling is not a sign of India's weakness. It can also be the reverse effect of its strength. It is hard to withdraw money from markets where there are losses. It is easy to withdraw money from markets where there are profits. That is why even strong markets sometimes become targets of selling. This has more to do with psychology than with data. The second big reason is the behavior of global capital. Foreign portfolio investment often chases a story. Today, the story is technology and AI in the US. Tomorrow, it may be another country. When a new narrative emerges in developed economies, capital gets pulled there. India's story is long-term, slow, steady, but deep, whereas many foreign investors look for short-term triggers. The third reason is fear around valuations. Over the past few years, valuations in many Indian sectors had gone up. Among foreign investors, there has been frequent discussion that India has become expensive. However, this argument is incomplete in itself. Valuation is not determined only by today's price, but by tomorrow's growth. If growth is strong, high valuations also become normal over time. Still, many funds reduced their exposure because of this fear. Now let's come to the most interesting part: sentiment. Markets do not move only on numbers. They move on emotions. When a narrative keeps building that foreigners are selling, other foreign investors also become cautious. It creates a kind of chain reaction. Meanwhile, domestic investors, through SIPs and retail money, have absorbed much of this selling. This, in itself, is a new strength of India, the rise of domestic capital. Understanding the role of the government and the RBI is extremely important here. On the monetary policy front, the RBI has shown balance. Neither excessive tightening nor excessive easing. Inflation control, financial stability, and liquidity in the system have all been kept in balance. On the other hand, the government has sent a clear message through fiscal policy that the focus will be more on infrastructure than on freebies. Roads, railways, ports, defense, and manufacturing. These are the areas where the government has invested money. This investment will also trigger private capex in the coming years. History shows that when the government spends on infrastructure, it builds confidence in the private sector as well. And this confidence boosts employment, income, and consumption. A chain is created that moves the economy forward, slowly but steadily. Still, there are some real challenges that cannot be ignored. Red tape, complexities in company registration, and policy ambiguity in certain sectors. These are the issues that worry foreign investors. India does not need to adopt an East Asia-style export-driven strategy because its domestic market itself is very large. But the easier it is to do business, the more both foreign and domestic investment will sustain. When it comes to external risks, the India-US tariff issue is also a major question. US policies often change suddenly. Tariffs are imposed and then removed. This uncertainty scares markets in the short term. But in the long run, trade always finds a way. If one route closes, another opens. That is what history teaches. In addition, the aspect of commodity prices is also important. Softening oil prices have been a boon for India. This provides relief to both the current account and inflation. However, rising gold prices create a different kind of pressure. But overall, the commodity cycle currently appears to be in India's favor. Now the big question, the road to 2026. Will foreign investment return? The answer is probably not a simple yes or no rather. It depends on when investors realize that they may have exited India too early. When growth in developed economies slows down and India maintains its steady pace, the direction of capital will change again. Because in the end, money is driven not by emotions, but by returns. Many times, markets make their biggest mistakes in this very way, fearing the most at the best opportunities. If India stays committed to its reform path, and if growth continues to be visible on the ground, then today's foreign sell-off may be remembered tomorrow as a major miscalculation. So now the question is for you. Is this foresight on the part of foreign investors or hest? Will India's rocket speed leave them behind? Or is a major turning point ahead? The answer still lies in the womb of the future. But one thing is certain, the story is not over yet. The real game may just be beginning.
If our video has taught you something new, do not forget to like and share this video so that this information can reach others as well. Your likes and shares are a source of inspiration for us. If you have any questions or suggestions, please let us know in the comments. It will be our honor to answer your questions and listen to suggestions. And yes, if you like our content, subscribe to the channel and press the bell icon so that you stay connected with every new story. Thank you. GRT Business YouTube channel sources, news from various news agencies, opinion polls and other public sources. We try to ensure that every report and summary is accurate and verified, but we are not responsible for any dispute or error. Our aim is only to provide you with accurate information.